Today, I want to help you answer the question, what is loan flipping in real estate? This term often gets conflated as something that is always good, but there could be a potential downside to it. So stick with me because by the end of this video, you're going to have a very clear understanding of what loan flipping is and how it can be a danger to you as a real estate investor. When people hear the term loan flipping, I imagine a lot of times they always think it has something to do with making money. But it can actually be a dangerous predatory practice that, if engaged in, can hurt you as a real estate investor. So let's dive in as I first explain what loan flipping is. Next, I want to talk about the dangers of loan flipping. And finally, I'll explain if there is ever a time where you will utilize this practice. If you're ready, let's go. So what is loan flipping? Loan flipping is a predatory lending practice that involves convincing homeowners to refinance their property on a continuous basis. And each time it's usually with higher fees or higher points. So is it always a situation where somebody's taken advantage of you? You would hope not, but there are going to be times where interest rates are consistently going down. I remember the first time I got a loan, I'd bought a condo and interest rates were really high. I think they were high nines. And I got my first loan, and I remember my payment being fairly high. And I also remember that somebody had come to me just about 6 months later and said they could get my interest rates down about a whole point. And I remember thinking, okay, I'm happy to do that because my payment was going to drop significantly. And I kept having people approach me because interest rates started to drop all the way from 9.5% all the way down to about 7.25. And in doing so, I think I refinanced 2 times. But as a young investor just getting started in real estate, I honestly didn't have a lot of the tools or knowledge or resources to understand exactly what was happening. And then all of a sudden I was approached by somebody who said, listen, we can get your payment down to about half of what you're paying right now. And it's something called a reverse mortgage. And I remember thinking, okay, what exactly is a reverse mortgage? I like the idea of a lower payment, but a reverse mortgage was something where by the end of you paying off supposedly a 30-year term, you were going to owe more on your home than you did when you first started making those payments when the loan was originated. I know that seems crazy, but that's how those things work. And this was a prime example of loan flipping. So what are the dangers of loan flipping? Now, every time you refinance, you're probably going to have more debt. They bake in cost and points into the loan. Because they might be able to get a lower interest rate, the overall monthly payment might be lower, but what you owe and the debt that you incur is probably going to go up. Another danger is potentially higher interest rates. Now, you say, well, why would I refinance into a higher interest rate? Well, there could be a reason. A lot of times people might have equity in their home, so when they refinance, they're pulling that equity out, even if it means they might be paying a higher interest rate on that loan. Another danger of loan flipping is reduced equity. Now, if you built some equity up in your home and somebody convinces you to refinance, to pull that equity out, to do something with it, that could also be something where you lose equity in your home because you're taking it out right now instead of building that up in the asset that you currently have. And a final danger of loan flipping is additional fees. A lot of times when you're continually flipping or refinancing a loan, there's going to be fees associated with that. And a lot of times they bake those fees into the actual loan itself so you don't necessarily see them right away. But let's say that you owed $120,000 on a piece of property and all of a sudden you refinance that and you have equity in it up to $200,000. You might pull $30,000 out of that loan, but all the fees associated with it, all of a sudden, instead of having a loan where you owe $150,000, it might be $155,000 or $157,000 because there's baked fees, points, and costs associated with that. Because whoever is convincing you to refinance that piece of property, they need to make their money. And a lot of times their fees are baked into the loan so you don't feel it up front, but it's baked into your overall monthly payment. So is there ever a scenario where you would consider utilizing this practice? For the most part, I would say no. And understand, I'm not saying that you should never refinance your home, that you should never pull equity out of your home, but the situation needs to be right. It needs to be something where there's a much lower interest rate that you can take advantage of and that you have a place to utilize that stored up equity into a potential another asset. So when should you do it? Well, we had a scenario like this not too long ago. When I first got into short-term rentals, we got in at the right time. Interest rates were really low and prices were still fairly low. We bought a property in Florida, close to Orlando. And I remember we bought this property with a very low interest rate and a really good price. And prices just started to increase. Over the next 12 to 18, 24 months, I saw the price of this property go up nearly 30-40%. So it was a significant increase, and we're still looking for additional short-term rentals to buy, and one had come up. And rather than going and taking more money to put as a down payment, we refinanced our home in Orlando, and we took that money and put it as a down payment on another short-term rental. Now that increased the debt, and the interest rate did go up, but I had an opportunity to purchase another cash flowing short-term rental. So in my mind, that would be the time to be able to utilize loan flipping as a strategy when you can take money or equity that you build up and put it into another asset that is producing income. And the last thing to consider if you're thinking about ever doing loan flipping or refinancing over and over again is your situation, right? You got to understand, what is your situation? What is your goal? What are you looking to get out of your investing strategy? Now, obviously, if you're thinking about short-term rentals or long-term rentals, obviously the lower interest rate you can get for the lower payment, that makes it more of a cash flowing asset for you. Now, if you're looking to flip pieces of property and invest in a property where you purchase it, maybe fix it up or do a slow flip, and you're looking to turn that property over in a short period of time, an interest rate might not make that big of a deal because you're not going to be holding up for a long period of time. And I always try to give advice, listen, if you're going to go down that route where you're investing in real estate, you want to surround yourself with a quality team of real estate agents, lenders, investors, people that can help you in these situations. So if you ever get caught in a situation where you're not sure what to do, you could ask people that you know, like, and trust. They can give you feedback and information to make the best informed decision possible. Now, obviously, when you get a loan in real estate, there is a lot of different strategies you can utilize. And one that I've been seeing a ton of success with is something called cash flow flipping. Now, it's a strategy that I've come up with, and I'm giving away my free ebook on exactly how to take advantage of this awesome strategy. Just go to my website, cashflowflipping.com, and you'll get the book for free, 100%, no obligation, no questions asked. And it's something that will help you understand this awesome strategy where you can start making money right now, no matter what the market's doing, with little to no money out of your pocket. Thanks for stopping by. Have an amazing day.